And generally when you get to the end of the year, what happens is that the market and everyone starts thinking about what is going to happen in 2025, right? So, how do we position ourselves, what's important, and potentially what trades to put on, right? So that's what the market's doing at the moment. It's just wondering, what does the future to 2025 look like? So today my presentation, I'm going to talk about a couple of things. One of them is I'm going to talk about the forecast for the Federal Reserve. The Federal Reserve is obviously the most important central bank globally. Not only does it influence US markets, but what it does influences global markets, right? So if you can get the Fed right, or understand what the Fed's doing, you're going to be one step ahead of the game, right? So we're going to talk about the Fed. The other thing we're going to talk about also is US inflation expectations. Obviously they are super important for the simple reason it's because that influences the Fed, yeah? So we're going to talk about those two things, and then I'm going to finish up and give you guys a Christmas present that potentially there is an issue, a problem coming next year, which could be potentially the biggest trade of your life, right? Right, we'll get to that, but I'm serious, it could be, okay? Okay, so let's start off with the Fed. So in 2020, obviously, COVID happened. The response from that was the Fed dropped interest rates to an emergency rate, which is pretty much zero, like every central bank did in 2020, and they engaged in money printing, right? They kept those rates low for 2 years, till 2022. 2022, literally COVID was over, the world went back to normal, so we did not need those emergency rates at zero anymore, yeah? But what also happened in 2022 is we experienced a big spike in inflation, yeah? So in the US, inflation went up to 9%. So not only did the Fed have to get rid of emergency rates, they had to go and fix a 9% inflation, yeah? So the Fed aggressively raised rates. And what they did, so from 2022 to this year, 2024, they raised rates to a peak of 5.25% for the Fed funds rate, yeah? So what happened is that taking rates up for 2 years and taking it up to 5.25%, that level of Fed funds rate actually worked its magic on inflation like it's supposed to do. And in July of this year, the Federal Reserve pivoted, okay? So the Fed actually said to the market, we have confidence that we've made progress to inflation to our 2% mandate. So basically the Fed wants inflation down to 2%. And because that they are obviously confident that now that inflation was going down to their 2% mandate, that they now did not need rates at 5.25%, and they could start cutting rates, right? So of July this year, when the Fed pivoted, the market then priced in that the Fed would aggressively cut rates. So by the end of 2024, they would cut rates by 100 basis points. So take the rate down to 5.25%, yeah? Now, at the same time, that was the forecast for the Fed for the end of this year. The market was forecasting for 2025, which is next year, for the Fed to actually take it down an additional 100 basis points to 3.25%, right? So this is the initial thinking of the market when the Fed pivoted, that we would get 4.25% this year, and we would go into a much lower Fed funds rate of 3.25%. Now, the Fed has met, the first time they cut rates was in September. They cut by 50 basis points, right? So they started off aggressively. In November, we got another 50 basis points. Not 50. We got another 25 basis points in November. 2 days ago, we got another 25 basis points. So effectively, we got exactly what the market was expecting. Got 100 basis points, 5.5. This is the current Fed funds rate, 4.25%. So the market got exactly what it was expecting, yeah? Now, 2 days ago when we had the last Fed meeting of the year, it's an important meeting for the simple fact is that once a quarter, so once every, just 4 times a year, what the Fed does is they have what's called, they release the dot plots, right? So the dot plots is basically every single Fed member gives their forecast of where they believe that the Fed funds rate, this rate here, will be in a year's time, yeah? So it's not something that is set in stone, it has to happen. It's just with the current economic conditions where they are right today at that Fed meeting, this is where the Fed members believe that interest rates will be next year, right? So it's their way of communicating to all of us, to the market, to the whole world. This is what we think we're going to do with interest rates, right? So if everything continues the way it is, this is what's going to happen, right? So on Wednesday night when the Fed came out with the dot plots, so this is the dot plots here, right? This is 2025, yeah? Each dot there is basically a Fed member saying where they believe interest rates will be in 2025, yeah? Here, on this axis here, we've actually got the Fed funds rates, yeah? So most of them, they agree that basically rates should be around 4%, right? One guy actually thinks they should raise rates because it's currently at 4.25. He thinks they should be up at 4.5%, right? 3 guys actually think that rates should be unchanged at 4.25, right? So they don't even want to cut anymore, right? These guys are saying one more cut, that's the majority. And there's a couple more that are thinking that they should be cutting more, right? Now what this here in the red is basically the average of these dot plots and the Fed, the interest rate, yeah? So it's at 3.9%, okay? So basically the Fed members believe that on average, that next year the Fed funds rate will be at 3.9%, right? So if we can do some basic maths, 4.25 is the current Fed funds rate, yeah? These guys think, so 4.25 minus 3.9, right? That's 35 basis points, yeah? So this is big shock to the market, yeah? All right? This is a massive shock to the market. Basically, one rate cut by the Fed, 25 basis points. This is not even pricing in 2 rate cuts next year, yeah? So this is basically pricing in that the Fed expects to cut rates one more time next year, and then they're not agreeing on another cut after that, right? Not even 50-50, right, on a second rate cut. Now this is, so when on Wednesday when the Fed met and they cut rates by 25 basis points, that was expected, right? Market did not move on that rate cut. Market loves rate cuts, right? This is good for them, right? What they moved on was this dot plots, right? It was basically the Fed telling them that next year, these guys have had enough, right? They don't want to cut rates anymore, yeah? So they're basically saying that they've done the heavy lifting, right? Doing from 5.25 to 4.25, and the Fed's saying, that's it, we're happy now, right? We're not, this is not happening, right? 100% gone, right? Yeah? So the initial expectations of the market, and even though the market did actually, they weren't actually expecting 3.25 in the end, right? But they were expecting minimum 2 rate cuts by the Fed next year to 3, right? That's what they wanted. And they're not even getting 2 rate cuts. So what the key takeaway from all this is that next year you're going to see a Fed that's going to be doing not a lot, right? Okay, they're going to be on the sidelines, they're going to be watching, and they're not going to be supporting the market with more rate cuts, right? It also is a big deal because you've got the Fed that's going to be sitting, say they cut rates one more time, take it down to the Fed funds rate down to 4%, yeah? Which is, all the Fed members agree on one more, take it down to 4%. Just to give you an example, right, the other biggest central bank in the world, the ECB, just cut their deposit rate to 3%, yeah, right, last week. At the same time when they did this, they basically said to the market, we were thinking of giving you 50, right? We were thinking of giving you 50, but we gave you 25. Every single day after the ECB meeting, ECB speakers have come out every day and said, listen, every single time we meet, we're just going to give you gradual 25 basis points, right? ECB is going to take rates down to 2% easy next year, yeah? You've got a Fed at 4, right? Right? So basically, you're going to be seeing next year a Federal Reserve that has much higher interest rates, right, than all of the big central banks around the world that are still cutting, yeah? This is what has spiked US bond yields higher. This is what has spiked the US dollar as well, yeah? So this story of the Fed is, it's the strongest central bank out there, right? No other central bank can compete with this, right? They're not even close, yeah? And this is a big deal, right? So that's the key takeaway, is that the Fed is going to be the strongest central bank out there with the highest rates, the highest US dollar, the highest bond yields. So yes, look, big. That's the big key takeaway to see next year, yeah? Now, why, so we'll move over to inflation now. So why did the Fed pivot away from 3.25% to now, the 3.9% yield, yeah? There's a few reasons for why. The first one is that when they first started cutting rates in September, they cut by 50 basis points, and obviously the pricing for more aggressive cuts was still there. But what did happen is that all the economic data that came out of the US has been well above expectations, right? Economic data has outperformed in the US, right? Last night we even had quarter 3 GDP revisions, right? Went from 2.8%, they revised it up to 3%, right? This is not an economy that is going into a recession. 3% is very positive growth. Recession is negative growth, right? So here you've got a US economy that is growing solidly. You don't cut rates, right? You just don't, right? You raise rates to cool economies like that, right? Retail sales, positive. Manufacturing, not contractionary, showing recession. Manufacturing's great. And the big one is employment, right? So US non-farm payrolls, the Fed thought by the end of the year unemployment rate would be 4.5% or higher. The complete opposite's happened, right? It's still down around 4.1%. It's doing exceptional. Each month they're adding 200,000, 150,000 jobs, right? This is a healthy looking economy, and you don't cut rates, right? When you've got an economy that's firing like this, yeah? So that's one thing. That's why the Fed can't do this anymore, right? It's ridiculous. It's stupidity, right? The second thing is that on early November, the 5th of November, Trump won the US election, right? His number one policy is tariffs, yeah? There is no faster way to bring inflation back than just overnight putting a 60% tariff. Here's this was worth $5 one day, and the next day you say it's worth 10, right? That's what Trump's doing, right? There's no progression into the inflation. It's overnight, boom. Anything that comes in from China, 60% more expensive. From Australia, maybe 10 or 20. From Mexico, maybe 40%. We'll find out. But anyway, he's going to add to inflation, yeah? So the Fed also they're not stupid. They can see what's going to happen. They don't want to be cutting rates too aggressively until they find out exactly what's going to happen with inflation with Trump, right? So that's another reason that's a big change. Maybe if he didn't win, we wouldn't be talking about this as much. But anyway, so Trump. The third thing, the reason why this has changed, and that the Fed is only looking at 3.9% for 2025, is actually inflation, right? In October of this year, this was US inflation. This was the lowest since 9%. The lowest it went was 2.4%. And this was what the Fed was cutting interest rates because it was getting so close to the magic 2% goal, yeah? In November, this went to 2.6% US inflation. It's going away from 2%. In December, a week ago, it's gone up to 2.7%, yeah? The last inflation number we've got, so it's gone from 2.4, 2.6, 2.7, and it's supposed to be at 2%. You're cutting rates when inflation's going back up, right? This is madness, right? It's just pure madness. Anyway, so next year, the inflation numbers are going to be very closely watched by the whole market. They're going to be very volatile. And this is even before Trump's tariffs have come in, yeah? Trump hasn't started until January the 20th. So inflation is going up even before Trump adds on to inflation, yeah? So look, in January, so when you get the inflation reports, they're 1 month lagging, right? So the January number is actually going to be December inflation, right? So there's going to be no Trump in the January number. In the February number, that's going to be the whole of January. So what you will have, Trump starts on the 20th, you might have a little bit of the Trump's tariffs. I don't know how fast he's going to implement those, but in March, you'll have the whole of February inflation, right? Trump would have well and truly been in power by then. So we'll start getting the actual tariffs, probably increasing inflation. I'd say from March onwards is when it could really start to accelerate, yeah? So I would be shocked if the Fed, they won't, but this is when we really need to start focusing. And if in the January and February numbers keep increasing before March, ooh, geez, we've got problems, man. Serious problems. Okay, so inflation going up. So let's go to the next chart, please. All right. So this chart here should give you nightmares, right? This should scare you. It really should scare you, right? No, honestly, you might look back at this conversation and you think, oh my God, I wish I listened to this bit, right? This bit is probably the most important bit I'm going to talk to you about, right? So anyway, there's two charts superimposed on each other. So the blue line, can you see that this one's blue and one's green? Yeah? Can everyone see that? Mm-hmm. It's important, yeah? Right, so the blue line is like the 1970s going through the 1980s, yeah? Do you get that? This green line is 2014 to where we are now, 2015, yeah? See the green line? So that stops now because we haven't seen the other years yet, yeah? So let's just start off first with the blue line, what happened in the 1970s, right? So you had inflation, look at around 2-3%, which is not a big deal. Then all of a sudden you see this massive spike up inflation up to, it's actually the other axis there, up past 10%, right? What happened is that the Fed obviously it's cut rates and whatnot. Then you had a period where inflation actually based, but started marginally going back up. And what happened is that the Fed was still cutting rates, right? The Fed was still cutting rates when inflation was starting to base. It wasn't going lower anymore, and it was certainly still well above, like say 2% targets or something. But okay, it was well off the highs. The Fed still continued to cut rates, and what happened is that you had this huge inflation spike. Yeah. So what happened in 1980 is that they had a change of Fed governors, right? And a guy called Paul Volcker came in, right? And he was one of the most famous Fed governors because what he did is he took the Fed funds rate to 20%, right? So he took the Fed funds rate to 20% to tackle this 14% inflation, yeah? So what happened is that obviously he crashed the economy, right? So he crashed the, S&P was down over 20%. The economy went into a recession for a few years, right? But this is what this guy did to get rid of this policy error that the Fed did, right? Because the Fed kept cutting rates as inflation was going up and it caused this massive spike, this guy had to come in and raise rates to 20% to actually get inflation back lower, right? Anyway, will we see a repeat of the 70s? So this is the whole idea, right? Is that if you have a look between the years of 2014 to literally for 10 years, 2014, 1966 to 1977, right? So over those 10-year periods, I mean, I don't know if you can see, but inflation is literally has been, mirroring each other for that time period. Like they're rising together, going back down. Here it's base before it's taken off. Yeah, gone down together, basing together. I mean, it's just tick for tick, right? What's going on? The policy error happened here when the Fed was cutting into inflation. Basically basing marginally going up. We're committing the same policy error. Inflation is going back up, yeah? Inflation's going up and the Fed is cutting rates. Now, if history repeats, yeah, we get inflation spiking up like what it did in the 70s, and okay, we're never gonna raise rates to 20%, right? It just can't happen, right? Because the economy will crash, markets will crash well before 20%, right? But put it this way, even if we did half of this, right? You get a spike up in inflation, and then the Fed has to actually raise rates anywhere close to say 10%, yeah. With household debt, corporate debt, government debt, sovereign debt, at record levels, right? They could not take interest rates like an inflation spike like this, and a Fed that needs to aggressively raise rates. You will see the biggest financial crash of your lifetime. I promise you, right? If we see this repeat history. Next year, when I said one of the best trades of your life, and that will be to sell equities, yeah? Because at the moment, you've got equities that have been record high, you've got trillion-dollar companies, you've got bubbles everywhere maybe, the Nvidias, Bitcoins, all this sort of rubbish that's been going on, yeah? Vertical markets, yeah? Right? Like just in the last 2 years, 30% one year, another 30% next year, right? If the Fed has to, next year, inflation comes off with Trump and the fact that they eased, and you get a big spike up, and then all of a sudden they have to start raising rates aggressively. You're going to get a huge financial crash, yeah, and it will be the biggest you'll see in your lifetime, right? You only see in your lifetime two market crashes, right? In my career so far, I saw .com, but it was the early days of my career. I'd only been working for a few years, didn't really understand bubbles. I was actually bought tech stocks, right? I lost money, right? I was chasing the bubble. I was working in Hong Kong 7 years later when GFC hit, and I saw another market crash. That one I got, right? Because I learned how to sell equities, and it was the best trades I've ever done in my life, and I had a great time during the recession, right? Because I understood how to sell equities, right? So I won't miss, I know what to do the next time I see it. I might be lucky, I might see a third market crash, right? If this happens, because you will, right? Normally market crashes happen every 15 years or 10 to 15 years, yeah? That's what normally happens. GFC was 07, 08 or whatnot. We're 17 years since the last market crash, yeah? So we're sort of due for one. And certainly this is a recipe for that to happen. I'm saying, look, it's not guaranteed it's going to happen, yeah? But if history repeats what's happening here, and the Fed is cutting into inflation going back up, it's a policy error, that it could be one of the best trades, seriously, that you'll do. And so you really need to be focused on what's happening in inflation. And just quickly, I'll end it. The market you need to watch that will give you early warning signs is the US 2-year yield chart, right? So US 2-year yields is basically the closest that you're going to get where the market sets short-term interest rates, yeah? So where the Fed funds rate should be going, yeah? So obviously when COVID happened, yeah, see, rates went to zero, 2-year yield went to zero, right? But as soon as inflation took off, right, inflation went to 9%, look what happened to these 2-year yields, yeah? Have a look at them spike, yeah? What do you think is going to happen to these yields if inflation goes again, yeah? You're going to get a repeat of something like this, but from levels much higher, this thing goes up to 10%. So what will happen is that the market is so efficient, right? Markets are stupid, right? Even before the Fed starts hiking rates, before the Fed does it, this is going to go, right? This will tell you, right? Because the market tells the Fed, hey, listen, guys, you're wrong. This 4.25% now is a joke, right? This could be at 8, 9%, right? And it's the market speaking, right? So if you see these yields going up, right, the equity markets won't wait for the Fed to act or any of this raise rates before they crash. They see these go, right? Then the stress is there, the trade's ready. Just sell equities like crazy, yeah. I mean, the highs for last year was 5.25%. It's exactly where the peak was for the Fed funds rate, yeah? No coincidence, right? We start trading above 5.25%, there's already a lot of stress. But you remember, the Fed funds rate is at 4.25%. So if this is already trading above 4.25% at 4.3, right? So if this starts trading up towards 5%, that's already the market telling the Fed, this is wrong. This is wrong, right? If this rate is actually trading lower, down towards, say, 3%, it means the market is seeing stress in the market, like economic data's deteriorating, economy's going into recession. So when this is falling, it's telling the Fed, you can cut rates. Like, we expect you to, yeah? So 4.25% is too high. But see, we're not below the Fed funds rate. We're actually above it, right? So if this does trade higher, that's the market already saying to the Fed, you're wrong, yeah? And it's stress. Equities will hate that, right? US dollar will love it. US dollar will love it. But definitely, you focus on this, and you could make a lot of money on equities, right? Because if this thing explodes up, and that whole inflation picture happens, we've got problems, yeah? And that could happen next year. Anyway, that's it.
Practically, what I want to talk about, it's, thanks, on the first page. So, just to recap on what Brett was talking about. Third point. Remember the last graph? So we were talking about soft landing or hard landing. Soft landing means, you remember the graph, right? So it was like still maintaining around this level. Hopefully we'll get back to 2. But because we're cutting rates, right? If what Greg said is right, if inflation's signing back to 3 or even 4-ish, which means, or even higher at 10%, we call it hard landing. So which means it's a consequence of Fed Reserve. If they start cutting rates too hard and see what the economy performs. So that is a big drive, that is a big theme for this year, because we're starting to cut rates already. So we don't know whether the US economy is going to do a soft landing or hard landing. That's one of the biggest themes this year. So I'm going to talk about more macro stuff. These are the themes for this year and last year, like global policy as well. I'm going to elaborate all this as well. Global policy means not only US, as you can see, many central banks are starting to cut rates, of course, as many, not all. As you may aware, some of the central banks actually are raising rates. You can name some, right?
Japan.
Yeah, so some of the economy are starting rates, but for instance, Japan, it's a different story because they're starting from negative for many years, for some years. But the global theme they will talk about is the easing global policy, which means the other central banks are starting to cut rates. So we're going to see this year, 2025, it's pretty crucial this year, is about how the respective economy is going to perform because of, it probably will, I will have other graph to elaborate on this, but more or less it's the same story, same as what we're doing here as well. If we're cutting rates, as you may aware, like starting to raise rate, we all suffer in some way. Mortgages, inflation, everything. So it's the same story as in the US. If we are going to see inflation coming back, as you can see from the RBA, so do we have enough, what we call it, bullets, or do we have enough cuts to cut rates? So this is talking about the easing global rates policy this year. And election impacts. So as Greg mentioned as well, tariffs. Why tariffs actually US election impacts, which means what US policy, why is important to the global economy? It's, as Greg mentioned, right, tariffs. What practically tariffs will impact us? Like, so as Greg mentioned example, right? If he put tariffs on China, for example, as you see for the last month, what happened to Chinese yuan?
Drop.
Depreciate, right?
Yeah.
Why depreciate?
Because of the tariff.
Why? Because of tariff. Because it's what exactly what
the
exactly because what Greg said, right? If I'm selling this pen, I made in China, and sell this pen to US for like $10. If they raise tariff for 50%, so it's $15. But if I decrease the currency at least like 10% or even 20%, which means that this costs only $8. So $8 increase 50% is only like $12. Compared to original $10, it's still relatively competitive to US products. That's the alternative. Same thing for us, right? Same thing for Aussie market. Okay, first, I will elaborate on this one, but think about it in the global thing. Did Aussie central bank RBA cut rates this year? Anyone recall? No. Do you know what's the RBA right now? RBA rates 4.35, which is what is the US Fed rate again?
4.25.
So are we higher rates, the lower rates than US?
Higher.
Higher theoretically, your currency is supposed to be stronger or weaker.
Strong.
But what happened to Aussie? 62.14 this morning. Why is that? Same thing, right? Think about the global policy, right? What is the biggest trading partner in Australia? China. So if China depreciates the currency, if our biggest trading partner is China, so if we stay the same, for example, say the same currency, what means by our export to China? More expensive because they depreciate. So I'm just quoting this as an example as why this election impacts most economy. Like by importing tariffs on China, it may import overseas food, but tariffs for us is not that much difference because our most trading partner is in China, but it indirectly impacts us because of the tariffs to buy China. And as Greg mentioned, I think you may recall, Donald Trump already said they're going to raise 25% tariff on Mexico and Canada already. And you may read from news that what Canada has been imposing other policies to react to the 25% tariffs. So means that election, what we call it election impacts, has a lot of impacts in terms of all the economies. And another thing is the China's stimulus package. As we are aware, for the last month, or actually for half a year, that China has been injecting money, changing rates, and doing lots of stuff, trying to, China, it's still a capital control country, but what they have done to the market hopefully has some great impacts in terms of the local economy. Because of the, I will have another graph to elaborate on this one as well. So, again, as Greg mentioned, strong equity market. Well, this is a fact we cannot deny, except China market, of course. But because of the capital inflow and outflow. But in generally, equity markets has been pretty strong for the last year or so. Well, sorry to say that if you haven't bought any US stocks, or technically a tech stocks, well, you are relatively underperform. But this is what the fact. It's the strong equity market. As I said, I'm doing it as a manager. As an asset manager, we don't have a strong view in terms of market how they're going to perform, but we will have a sort of global view, or we will take a market view of what market has been reading. The market consensus is the U.S. stock market is still pretty strong, especially on corporate earnings and in terms of corporate performance, I would say. Why? Next stop, it's AI. As we all know, the big four. That market is pricing AI will have a positive impact on, especially on productivity. Why? They are trading at 40 or 50x PE, because market is expecting this AI is going to increase productivity for many sectors, I would say. If you're into AI, you sort of have an idea of what potentially AI actually can contribute to productivity. So to make it, I would say, short, in the old days, the equities are mainly strong on asset-based equities, which is what a property, machine bases, automobile, IBM, that kind of hardware stuff. But for the last few years, I would say it hasn't changed to technology and because it's like asset-based stocks. The market cap is much bigger than the heavy asset-based stocks. So, as Greg also mentioned, right? Inflation, right? This is inflation for, I would say, the biggest, a few biggest economy in the market right now. As Greg also mentioned, right? So we are still actually one of the dangerous or sort of high-ish inflation country compared to, I would say, even the rest of the world. But that's why, actually that makes sense. That's why we are not cutting rates yet, because we have to wait to see whether we are in control of the inflation compared to the other economy, I would say. Next slide, please. So this is to echo about the easing global policy. So this is like the trend. The orange line is the net. The dark blue line is the hiking central banks. The light blue line is the cutting edge central banks. So you can see, like during the COVID, like it's all about before COVID, they were cutting rates, but starting from somewhere 2020 in the middle, then more central banks starting to increase rates. Even now, we are on a, I would say, lowering interest rate cycle as most central banks, what they're doing. Next slide, please. Greg also mentioned about the GDP, right? So we on this graph, we're talking about OECD economics, which means excluding China, right, for the time being. Well, this is quite understandable that during COVID, we are talking about a negative, like a negative GDP growth. But for the last few years, has been doing okay. So the trend has been doing a positive GDP growth. That's why, again, echo back to the central bank policy is why they're starting to cut rates. Is as long as the GDP is starting to grow, they don't want to kill the GDP growth. So as we all aware that the higher interest rate, the harder for the economy to grow in most cases. Yes, next one please. So this is again sort of echo to what Greg has been talking about. Compared to the high-ish, right? This is a company. This is cycle peak. Greg mentioned about US is roughly about the high inflation is about 9-ish. If you remember UK, we talked about 11%. During COVID, there was the very high inflation. For us, we are talking about 9-ish. But the current inflation, we're sort of back to our control level, which is echo to what Brad was talking about. Yeah, next one, please. So I'm going to switch the topic from macro into some specific topic, right? For gold has been performing quite okay, right? So I didn't have any slides on Bitcoin, but if you want to talk about Bitcoin, I can talk about Bitcoin because I have many projects on Bitcoin as well. And this is why I just want to take away Bitcoin for the time being. But this is saying the gold outperformed major currencies, especially in yen. What yen means, like, do you understand what yen means, like? This is like gold yen, this is like gold US and gold euro. Means if you buy gold, and if you use yen to buy, it's more expensive to use yen to buy gold, which means like for this graph, if you're starting from 2021, means that if you buy gold in using Japanese yen and convert back to Japanese yen now, you actually have 200% return just on gold itself. But this is my theory, right? Do you earn any interest rate in gold? For all the currencies, even now, if you buy yen, you still have a little bit interest rate. But for all the currencies, especially when they start to rate base. So, but theologically, if everything stays the same, would you buy gold? It won't give you any interest rates. But it's market demand and supply to force people, not force, there are many more demand on gold since 2021. Means what? Means people do not trust whatever assets in the market. They just want to park the money in the sort of safe haven. Not even US dollar for this one. Like, actually, in some ways correlated to US because gold is mostly denominated in US. But from my theory, it's the higher the gold, the dangerous about the market. In some way, echoes of what Greg has been saying. Means because it doesn't give you any interest. But why would you put money there? Means that people feel something wrong, so that I will park my money in gold. But it has been happening for the last few years. Means the market has been sensing something wrong, but still, more and more money flowing into gold. Next slide, please. So this slightly more. This graph is about the US dollar curve, the US dollar strengthness, I would say, to US dollar. So I compare to a couple of periods from 74, 85, 02, 09. This is on FX side, not on what Greg graph is on CPI, on inflation. This is on the US dollar index movement. So you can see roughly from all the cycles, they are starting to tumble. Remember, actually this is, I grabbed this graph from Goldman Sachs. So actually the reports come out in November. This graph comes in November. So they're already forecasting that because it's coming up from this trough, going back to this positive level. So which means what? Which means that market consensus. It's this is November already. The market consensus has to be a strong dollar, at least for this term. As Greg also mentioned, FX has a strong correlation with interest rate, which means that, as I told you, right, if Aussie is 4.35 and US is 4.25, theoretically you'd rather buy Aussie because Aussie gives you a relatively high interest rate. But why Aussie has been going low is because many factors, as I told you, and maybe on potential cutting rates as well. As Greg also mentioned, that the market Fed fund rates already pricing only 50 basis points or less on this year. But anyone look at what's the projection on the RBA cut rates next year? Probably 75 basis points, which means in the interest rate differential is slightly lower rates than US. That's why one of the reasons that's why Aussie it's not performing well these days. So, but in general consensus, the market has a strong consensus about strong dollar, as all the factors I've just mentioned about the election impacts, about everything, about economy, and this is also one important thing as well, right? This is on the capital fund flow from 2022 to until now. So the red one is China, the blue one is USA, the gray one is Euro. This graph actually has a lot of meaning. Means it's about demand and supply. I'm telling you, anyone what's Nvidia's trading PE right now? 50-ish, or maybe higher, 60-ish. Do you know what? For example, similar. Actually, it's not AI. Say whatever Apple. Apple has been doing. Apple has been doing it. What PE around? We talk about whatever, stupidly 50-ish or 60-ish. If you are familiar with China tech stock, just quote one China tech stock, say Alibaba or even any China tech stock. What are they PE trading right now? Low teens, extremely cheap from a valuation angle. But why? Why so cheap? And why? As I said, most stock market, which is like Dow Jones and trading at 40K, or even ASX is trading at six whatever. It's from time to time, all time high. But if you're familiar with China stocks or even Hong Kong HSI, no way back. Why is that? In terms of valuation, it's really cheap, but this graph explains it. It's just pure demand, supply, capital inflow. All the capital has been draining up from China and Hong Kong. Hong Kong is part of China now. So no money goes there. That's why even the stock is cheap, no one goes to buy. The same thing, because all the money flows to US, starting from 22, like almost $400 billion flow into US. So they have to invest somewhere, either whatever bills, bonds, or actually equities. Or even actually bills has been part of the same thing, right? Since 2022, would you buy at that time? Would you buy US dollar bills or you buy Aussie dollars, RBA bank bills at that time? Because we don't 5.25%, we only have 4.25% for RBAs, even for other central banks as well. That means the whole world, most money actually flying to US. Anyone read the news yesterday about Donald Trump and shaking hands with one of the Japanese people? The SoftBank people. They're going to invest how much? 100 billion. But anyway, there's only talk, but still means that it must be something flowing into US. So another 100 is going to add in here as well. It's not in digital in one go, but the story is more and more money is going to flow into US. That's pretty sure. The trend is looking like this. If you're an asset manager, for example, would you buy US stocks or would you buy China stocks?
US stocks.
Why? Exactly. If you buy China stock, even it's cheap, but if it's not performing, your client is just going to tell you, why would you buy US stocks? So it's going to follow the trend. We asset managers, it's like this one. Although in terms of valuation, if you're PE, if you're private equity, if you're hedge funds, you may play around with different strategies. But in terms of long-only fund, you have to follow the trend. The trend is It's pretty clear. And it's also with the political situation as well. So all the money has been drawing up from China. So it echoes with the first point that I mentioned in the first graph about the China stimulation policy, because China for now, they're not relying on foreign capital. They have to rely on domestic consumption or hopefully by exports. But a lot of things is going to impact for 2025. Is it? Just slightly talk about euro, right? Just slightly talk about euro. This is also talking about the fund flows, right? Talking about fund flows from 2016 to 2018, and this is of course US, right? Capital fund flows flowing into Europe. This is talk about 2017, 2018. The fund flows actually going out from Europe, but we are now talking back to Europe. That's why, in terms of euro, we are seeing even positive cash flow, positive money starting to get into euro. But in general, we're still talking about strong US dollars. Next graph, please. Okay, this is talk about interest rate differential, right? Interest rate differential about European bonds minus 1 year nominal interest rate differential. So you can see on the right hand side is a euro dollar. On the left hand side is about the differential interest rate. It's closely correlated, as I said. That's what I want to use graph as well. What's the US rate right now?
4.25.
What's the ECB rate right now?
3%.
And are we talking about what the projection again?
2%.
And what is the projection again?
4%.
So the interest rate differential is going to be
2.
higher, which means this is going to be lower. So a lot of different impacts, especially on many impacts will impact the currency and also the economy as well. But in general consensus, that's why Greg mentioned about the Fed policy. First point is about it's going to impact everything. Next graph, please. Okay, I think this is one of the last graph. So just elaborate in terms of the rates, right? So this is the realized rates. So as Greg mentioned, right? So US, we already cut 75 basis point. Actually, this is before the last week one. That's why. So we cutting 100%. The other central banks started to cut. So you see Aussie dollar, we haven't cut anything. But Japan already raised interest rates. The blue part, the light blue part, is about actually the dark blue line is talking about the market implied rates. So market implied, as I said, actually it's already changed. Market implied is going to cut another roughly 70 basis point in November, but since last week it has been changed to 50 basis point, even less. But I would say in terms of general consensus, the other currency, the market implied means what Brett mentioned. We can see from the Fed fund, albeit you can see from the futures Fed fund rate, you can price in using that to see what's market pricing for the cut rates this year. So, but in general, market has been pricing a pretty aggressive cut rates for central banks. Again, echo to what the first graph is, all the global bank easing policy will have big impacts in terms of the economy, and for us, probably on FX rate and on many things. I'm going to skip this one because deficit is going to be quite important as well. Like this year for Aussie, we are okay. We're still on sort of a balanced budget, but next year it's going to be quite tough for Aussie rates. But US is going to be quite big deficit as well. This is about the steepness, right? So if steepness means what Greg mentioned about the 2-year and 10-year. So this graph is talking about the differential 2-year and 10-year rate. So you can see that from starting from 2023, when they start to cut rates, which means that we have the front end, which is 2-year, or about the long end, which is the 10-year. We talk about roughly 50 basis point, especially US. And then it goes in the negative. when they started cut rates. And it goes to negative. It has been sort of negative for almost like 9 months or even 9 months, but it started getting to the positive and then getting to negative these days. Greg just mentioned about like roughly it's around par right now, but it has a big impact of what the policy and it's the impact of what market predicted in terms of the Fed fund and also of the market performance. If you remember what Greg mentioned about towards the end of this talk. Next graph, please. So I'm just showing a Goldman Sachs forecast in terms of a 10-year bill. 10-year is different from short-term, right? 10 years talk about the long-term economy movement, right? So if you recall, in terms of Aussie rates, right now we're doing at roughly 4.6. So market expected it's going to be around the same thing. Even if they cut rates, even if we cut rates to 3.75 or 2, the long-term rate shouldn't be too low, because like if too low means the market is not doing well. It will be like the Japanese economy. But but market already pricing, even the long-term 10-year rate is Indian right 1% right now, but market forecast is doing roughly 2%. So this graph actually is just talking about the market prediction about the long-term rates right now. Yeah, I think this is the last graph. Thank you. So in a nutshell, I would say this year is pretty challenging. So no one knows it's going to be like what Grant mentioned about market tumbles, or the other way around. We talked about market tumbles last year already, but we talk about every week for the last 3 months or half a year. We talk about historical high, historical high, historical high. AS6, if you turn on AS6, if you talk historical high, and same thing for Dow Jones, same for S&P. Well, it's there will be some correction, I would say, but in terms of how the market reacts will all depends on especially on the US dollar rate policy. Market is different from, I would say, 90s, 70s, or maybe 90s, even 90s, because nowadays the technology is much more efficient than the old days. And of course, it's a good reference to look at the old graph, but in the old graph, for example, even 10 years ago, can you short the equities? 10 years ago, can you short it?
No.
It's hard to short it if you know how to play the futures and stuff. But nowadays, can you short futures? Nowadays, can you short equities? It's very easy. How can you reverse? Even if you do a trade, you can easily do it in a mobile phone in a 1 second decision. So what I'm saying is the market is much more efficient than 10 years ago. So means that market will find a balance, or what we call it equilibrium. What's market trend will be. And if you are trading FX, you understand that it's not that easy. It's a short thing, but that's why the markets keep pushing up, because many people, if they want to short it, just squeeze you, just squeeze until you square your position, until then they start. Then usually it happens like that.
Yeah.
Whenever you keep shorting, it just keep going up, and whenever you square your position, then the market starts to go down.
Yes.
Something like that. What I'm saying is market has it also echo back to my first point about AI as well. Imagine AI, I can, not only AI, I can just write a simple program here. I can know every single position. If AI, because you go through a portal, right? You go to a portal, you go through a broker in order to place your bets, right? Not bets, you place your, place your trades. Oops. Place your trades, right? Place your trades. So it means that potentially AI can calculate the market demand supply, whether it's high demand or high supply. Even if the high AI potentially can take the whole world order to see where's the trend, where's the market demand coming from, potentially. So no one can beat math, I would say. If more demand of currency than the other one, that means it's going up. Same thing the other way around. So, but it's just the technology is not there yet, but there will be one day. FX is hard because FX is so huge, but in terms of stock market, it's not hard. The stock market is one exchange or a few exchange, and as long as you can get all the data, you can see the bid offer price, then it's not hard to get an AI machine to figure out what's the equilibrium on that price. That's why, again, echo to my first point is AI is going to just quote trading as an example, but there are many things in AI is going to improve productivity in a normal day-to-day life, I would say. That's why AI stock is trading at whatever 70x or 60x PE. But cool. So 2025 is going to be challenging. It's going to be exciting. Not challenging. Is it exciting? Of course, it may be challenging, but you have to be one step back and look at the big trend. Short-term cycle, will be noises, but I would say 2025 will have a pretty much trend that hopefully you can follow and you can have a glimpse of what 2025 is going to be. Okay, thanks a lot, guys.
Thank you.